Here is something that makes me genuinely angry. In a 20-year Schwab study, the investor with the worst possible timing still ended with $151,343, while the person who kept waiting safely in cash ended with only $47,357. I want you to hear that number. The person who bought at the worst day every year still crushed the person who kept waiting for the perfect moment. And that is the uncomfortable truth behind market timing. It feels responsible. It feels smart. It feels like you are protecting yourself from being the fool who buys right before a crash. But most people are not destroyed by buying on a slightly imperfect day. They are destroyed by losing years. My name is Josh, and here is what nobody tells you. Your instinct wants a clean entry point. A dip, a correction, a scary headline that lets you say now it is finally cheap enough. But the market does not send invitations. It does not ring a bell at the bottom. It usually gives you fear first, confusion second, and clarity only after prices have already moved. Schwab tested this in a simple way. 5 investors each put $2,000 into the S&P 500 every year from 2005 through 2024. Peter Perfect somehow picked the lowest point every year and ended with about 186,077 tenths. Ashley Action invested immediately and ended with $170,555. Matthew Monthly spread the money across the year and ended with $166,591. Rosie Rotten bought the high every year, yet still ended with $151,343 cash. Larry Linger waited in cash and ended with $47,357 dents. That is not a rounding error. The big loser was not the person with bad timing. The big loser was the person who never gave compounding enough time to work. Here is where it gets interesting. The days you most want to avoid are often sitting right next to the days you cannot afford to miss. J.P. Morgan showed that, over the 20 years ending December 31, 2025, 6 of the 10 best S&P 500 days happened within 2 weeks of the 10 worst days. Hartford Funds found that 76% of the market's best days have happened during a bear market or in the first 2 months of a new bull market. In plain English, the best days often arrive when your emotions are screaming at you to leave. That is why missing just the 10 best days over the past 30 years cut returns in half. Missing the best 30 days reduced returns by 84%. You do not have to miss many days to damage decades. Most people think market timing means being right about one big crash, but real life is messier. You sell because the news looks terrible. Then the market jumps while you wait for confirmation. Then you tell yourself it is too late. Then another scary headline arrives. Suddenly you are not making one decision. You are making 20 decisions, and everyone has to be right. Let me make this practical. Maya invests $500 every month for 30 years in a diversified portfolio. Daniel waits 10 years because rates are high, elections are coming, and he wants a cleaner moment. If both earn a hypothetical 8% average annual return, Maya's habit grows to about $745,000. Daniel's delayed habit grows to about $295,000. Same monthly amount, same assumed return. Different starting clock. The missing ingredient was not genius. It was time. This does not mean you throw rent money into stocks. Money you need soon belongs in safe places. An emergency fund matters. Your allocation should fit your life, your time horizon, and your ability to sleep when markets drop. But once long-term money is actually long-term, the game changes. Your job is not to predict next Thursday. Your job is to build a system that keeps buying through ugly Thursdays. So here is the simple action step. Log in tonight and look at your investing system. Are contributions automatic? Are you using broad, low-cost funds or ETFs that match your goals? Do you have a rule for what you will do during the next crash before the next crash arrives? If the answer is no, fix the system before your emotions get another vote. The market will always give you a reason to wait. Inflation, recession fears, election noise, a scary chart, a friend who sounds confident. But your future self will not ask whether you bought at the exact bottom in March or October. Your future self will ask whether you owned enough productive assets for enough years. At the end of the day, timing feels powerful because it gives you a sense of control. At the end of the month, time already starts to matter more. And at the end of your investing journey, the scoreboard usually does not care how perfectly you timed the market. It cares how much time you spent in it.